Welcome to video 8 of part 2 of the EA tax training enrolled agent exam preparation course. Tom here back with you to discuss specialized topics. This is the first of 2 videos covering topics that haven't been covered in the rest of the course. In this first specialized topics video, we will cover rental property, farmers, and tax-exempt organizations. Our free resources slide is kind of busy for this one because we've got 3 different topics we're covering. So the first 3 listed here have to do with rental real estate. The next 3 have to do with farming, and then the rest have to do with not-for-profit organizations. So as always, I do recommend that you get those, read those over to help you get a little deeper into this and just to give you another review of these various topics. So let's get started with rental property. And here we are talking specifically about rental real estate. So for individual taxpayers, they report rental real estate on Schedule E of their 1040. If you own just part of an interest, then you report only your share of income and expenses. So let's say you and your sister own a rental property together, 50-50, then you would put half of the income and expenses on your return and she would put half on her return. So that's the way you would do that if you both own part of the property. Rental activities are considered passive unless you are a bona fide real estate professional, which we'll talk about in a little bit. But for everybody else, the passive activity loss rules apply. You'll remember that passive losses can only be used to offset passive income. So you'll want to keep that in mind. We will talk about an exception to that, but that is the rule. Rental activities are generally going to be considered passive activities. If you provide substantial services such as regular cleaning, changing linens, or housekeeping, then that is a business rather than a rental activity, and it is reported on Schedule C instead of Schedule E. So this would apply to a lot of Airbnb type of properties. Think about a hotel. A hotel is technically renting out real estate. They're renting out their rooms, but they don't report everything as if it were a rental property. That is a business. They are in the business of providing these rooms to people. They obviously provide regular cleaning and housekeeping, etc. And so the same thing would be if you have a rental house that you are renting out to different people all the time, and you are cleaning in between and doing housekeeping. When I say you are doing it, you could be hiring somebody, but the point is you are having these services done in addition to just providing a place for people to stay. So that would be the difference between a business on Schedule C and then just a regular rental property on Schedule E. Of course, in this video, we're going to be talking about it as a rental property. That's what we are focused on. So let's have a look at Schedule E, at least page 1 of Schedule E, which is where rental properties are shown. And so you can see up here, you're going to have the properties listed A, B, and C, and then they're going to be correspondingly A, B, and C down here. And then you have to list the type of property, and it gives you the different types. And then for each property, you're going to put the number of days you rented it out for the year, the number of days you used it personally for the year, and whether or not you've got a qualified joint venture with your spouse for that property. Then you're going to come down and show your income. Now, Schedule E is also used for royalties, but here we're just talking about the rental income. So you just put your rents that are received and then all of your various expenses that will then total down to a net income or loss. Now, of course, Schedule E is also where individual taxpayers report their income from as corporations and partnerships and trusts, but that's on page 2 of Schedule E, but that was a topic for part 1 of the exam, not for part 2. Partnerships and S corporations report their rental real estate on Form 8825. As you'll recall, rental activities are not included in ordinary business income on page 1 of either the 1065 or the 1120S. Instead, they are separately stated on Form K and Form K1. So let's go ahead and look at the 8825. It's going to look a lot like the Schedule E. Here they've got a spot for 4 rental properties, and then you show your rent, show your expenses, and you come down to the totals. And then there's actually another page where you can put 4 more. So they've just got E, F, G, and H here, and you put the same thing. If you've got more than 8, then you could just attach more of these page 2s to your return to show the income and the expenses. So that's how S corps and partnerships report their rental income. If you're wondering, C corps do not have a special form for rental income. It's included on their page 1. So they just include the income in rental income, and then they include the expenses in their expenses in order to report it for a C corporation. When we are talking about the income for real estate, it's going to include all rent received, including advance rent and lease cancellation fees. So that all gets included in income. Security deposits, when they are made, do not get included in income at the time they are received. They do get included in income if you end up keeping it. So obviously the security deposit is put down in case there's any damage to the property or anything like that. So if you end up at the end of the lease term keeping the money because there was damage to the property or what have you, then you go ahead and include it in income at that point in time. If instead you give the money back at the end, then that is not an expense because you have not included it previously in income. So when you first get the security deposit, and from an accounting standpoint, that is actually a liability because you actually still owe that money to the tenant until you get to the end of the lease term and you see whether or not there's a problem and you need to keep that security deposit. But until that happens, you owe that money to the tenant. So it is a liability rather than being counted as income. So then at the end, if you give it back, then you simply reverse that liability. You don't call it an expense and you just give the money back. If you keep it, then you count it in income at that point. Real estate deductions. Deductible expenses include all of the following: mortgage interest, not your mortgage payment, but just the interest portion of the payment, property taxes, maintenance and repairs, cleaning fees, utilities, insurance, advertising, depreciation, management company fees, and obviously there can be others, but these would be the major ones. Notice on maintenance and repairs, it does not include additions and improvements. So when we talked about assets and depreciation, we had the conversation about capital improvements versus maintenance. So it's the same thing here for rental real estate. If you are maintaining or repairing something, that is an expense. If you are making an addition or an improvement, then that is not an expense. That gets added to the basis of the real estate and then it can be depreciated. So you want to make sure that you can distinguish between those things. Remember, an addition would be putting in a whole new driveway, whereas a repair would just be patching up an existing driveway. An addition would be adding on a whole new room, whereas a repair would be just making repairs or painting or something in an existing room. An addition would be adding a whole new air conditioning and heating system, whereas a repair would be just having the repairman come out and to fix the existing HVAC system. So you'll remember those distinctions, and you will want to remember that that applies to rental real estate as well. Depreciation, you may remember from our depreciation video, residential buildings have a depreciable life of 27 and a half years. Commercial buildings have a depreciable life of 39 years, and those are going to be depreciated straight line with a mid-month convention. But you do want to remember for the exam, 27 and a half years for residential, 39 years for commercials. Some items that are included in the purchase might be personal property rather than real property. And of course, personal property can be depreciated over a shorter time period, which results in higher deductions in the earlier years of ownership. Some buyers of commercial properties will actually hire engineers to go out and do what's called a cost segregation study to break out the personal property from the real property. So when you get into some of these buildings, especially commercial buildings, it can be kind of tricky to say, well, is that piece their personal property or is that part of the building itself and it's real property? So you can get experts who can come out and distinguish between the two. Then they give you a report, and then you can use that report to now depreciate the personal property over the appropriate life, but it's going to be shorter than the life you're going to use for the real property. And then, of course, you would depreciate the real property of that commercial building over those 39 years. So the key point to remember is that if you are buying both personal property and real property, then you would want to separate those and depreciate them as appropriate. So, for example, if you're just buying a rental house, maybe that's already furnished. And so the furniture and the hangings on the walls and the appliances, things like that, those would be personal property. So you would want to separate those and depreciate those over a shorter period than the rest of the house. As we said, rental real estate is a passive activity unless you are a bona fide real estate professional. And of course, passive activity losses generally cannot be used to offset non passive income. But there is an exception for rental real estate if you meet a few criteria. So the first thing is you have to actively participate in the activity. Active participation means you own at least 10% of the property and you make management decisions in a significant and bona fide sense, such as approving tenants, rental terms, and expenditures. So, this exception is meant for the average middle class person who owns a rental house or two, as an example. So you're going to see in a little bit, there's also some adjusted gross income restrictions on who can take this. But the idea here is you own a rental house or two. You are the one who is making all the decisions. You're advertising it. You're negotiating with the tenants. You are negotiating the terms of the lease. You are deciding what expenditures to make, what gets fixed, what gets replaced, et cetera, and so forth. So that's who this $25,000 passive activity loss exception is aimed at. So if you actively participate in the activity, you can use up to $25,000 of rental losses to offset non passive income. So it's an exception to the general rule of not being able to deduct passive losses. So they're still saying it's a passive loss. They are just saying you can deduct up to $25,000 of those losses in this particular instance. And if you're married filing separate, then it's only $12,500. This allowance is phased out for those with higher incomes. So the $25,000 allowance is reduced by 50% of the amount that your modified adjusted gross income exceeds $100,000 or $50,000 if you're married filing separately. So let's say you are a married couple, you have a rental home, and you have adjusted gross income of $110,000. And then you have a loss from a rental property of $20,000. Normally, you could not take that $20,000 loss, but because of this exception, you can take some of it. But because your AGI is over $100,000, you can't take the whole $20,000. So your AGI is $110,000. Half of that is $5,000. So you cannot take $5,000 of that loss. So your $20,000 loss would now be a $15,000 loss. So that's how that works if your AGI is over $100,000. Obviously, if your modified AGI gets to $150,000 or more, then you're not going to be able to take any of your loss from that rental real estate. If you cannot take part of your loss because it's a passive activity and you meet these limits, then remember you can carry that over to the next year to offset passive income that you may have next year. So maybe this year the house was at a loss and you couldn't take that loss, but next year there's actually profit. You can use this year's loss to offset next year's profit. And if there's any more left over after offsetting next year's profit, then you can carry it forward to the next year, and so on and so forth. So let's talk about this real estate professional rule. So a qualified real estate professional does not treat rental real estate as a passive activity, and thus they can use losses in full to offset non-passive income. So what they're saying here is if real estate is your profession and you are a qualified real estate professional, then it's not passive. You're working. This is what you're doing as your job. So it's not a passive activity. Therefore, if you have a loss, you can use that loss to offset any of your income. In order to be considered a real estate professional, you have to meet both of these requirements. First, more than half of the personal services you performed in all your trades and businesses during the year were performed in real property trades or businesses in which you materially participated, and you must have performed more than 750 hours of services specifically in real property trades or businesses in which you materially participated. You do not count personal services that you performed as an employee in real property trades or businesses unless you owned 5% or more of the business. So if you work for somebody else, let's say you're an accountant for a property management company and you don't own any of that property management company. Well, your hours spent as an accountant for that company do not count for purposes of being a real estate professional. Now, if you have a property management business, let's say you own one, that's what you do for your regular full-time job, is you have a property management business, that would count. So if you also then have your own rental real estate, in addition to having that property management business, that rental real estate then would count as part of your real property trades or businesses, and it would not be passive, and therefore you could take any losses to offset your other income. So just remember these rules. More than half has to be in real property trades or businesses, and you have to spend at least 750 hours working on those real property trades or businesses. Renting part of a property. So you may have, for instance, a duplex where you live in half and you rent out the other unit, or you may just have one house that you have and maybe you rent out the basement, or maybe you rent out one room in the house. So if you have that situation, then you need to divide expenses that affect the whole house between those that are personal and rental. So the expenses would be things like your mortgage interest, your utilities, real estate taxes, painting the outside of the house, anything that affects the whole house need to be divided between personal and rental. So if you had a duplex, for instance, and they were equal size, and you rented one and lived in one, then you would just take half of those expenses. Half would be considered personal, and half you could deduct as rental expenses. So you can divide it based on total square footage or number of rooms, depending on what is most appropriate and what most accurately reflects those expenses. So the IRS will let you use any reasonable method, whether it's square footage or number of rooms. You just have to figure out what makes sense in your particular circumstances. So if you've got a basement, for instance, that you are renting out, maybe you've got a little apartment down there, it's got a little kitchenette, it's got a bathroom, it's got a separate entrance. Well, you can take the square footage of that basement, divide it by your total square footage of the house, and that percentage of those expenses you would then count as rental expenses. Some things it says, for instance, utilities, if not separated. If the unit or the room, even the basement, has a separate meter, for instance, for the electricity and for the water, and you are paying that, then you can just use whatever comes from that separate bill. In that case, you'd be getting two separate electric bills or two separate water bills. So in those cases, then you would just obviously deduct that utility bill that applied only to that rental portion. But if you just pay one electric bill for the whole house, then you would divide it using this method along with your other expenses. So that is how, if you rent out part and you live in part, you separate those. So just remember, for the exam, you do need to separate out those expenses. So the personal portion of those expenses are not deductible. And that the way you do that is by using the total square footage or number of rooms, whatever makes most sense in the circumstances. Renting out a home, whether it is your main home or a vacation home, this brings up some special rules that we will talk about here for a little bit. If you rent out a property for part of the year and use it for personal use for part of the year, such as a vacation home, then again, you are going to have to divide your expenses between rental use and personal use. So, how do you know, first of all, if something is considered a home? Well, obviously, if it's your main home, it's easy. You know it's your main home. But the questions usually come up with a vacation type of house. How do you determine whether or not it is a quote unquote home, and you therefore have to divide the expenses between personal and rental? So, the rule is, if you use that home for personal purposes for a number of days that is more than the greater of 14 days, or 10% of the total days you rent it to others at a fair rental price, then it is considered a home, and you have to divide your expenses between personal and rental. So, for instance, if you rent the home out for 100 days per year, and you use the home personally for 18 days during the year, that would be considered a home because it is greater than 14 days. 10% of the total rental days would only be 10 days. So we don't use that. Instead, you have to use the 14 days because it's the greater of the two. You use it for 18 days. So that would be considered a home, a quote unquote vacation home. And then you have to separate out the expenses between personal and rental. If, let's say, in that same example, you use it 18 days a year, but you rent it out 200 days of the year. Well, 200 days times 10% is 20 days. You use it less than 20 days. Therefore, it is not considered a quote unquote home. And you can just deduct all of the expenses just like you could with any other rental property. You do not have to separate out personal from rental expenses. When we talk about personal use, what do we mean? Well, obviously, if you use the home, that is personal use, but also if any other owner uses the home, that is considered personal use. So you and your sister own a vacation home together. You only use it for 7 days, but then your sister uses it for 14 days. You have to count that as 21 days of personal use. Similarly, if a member of your family or a member of your sister's family, in this example, use the home, those are also considered personal days. So it's use by the owner or owners or members of their families. They are all going to be considered personal days. There is the exception, though. If you rent the home to a family member and they pay a fair market rent and they use it as their main home, so it's not a vacation home. This is basically a rental property that they live in, and you are renting it to them just like you would rent it to a stranger. You're charging the same amount, then that will not be considered personal days. Other personal days would be anyone who, under an agreement, lets you use some other home. So you may have seen or heard about these websites where people who have rental properties in different parts of the world can swap, they can exchange. So maybe you've got a rental property on the beach in Florida, and there's somebody over in Switzerland who's got a rental property in the mountains, and they want to come to Florida and you want to go to Switzerland. So you say, okay, you can use our beach house for 3 weeks and we'll use your mountain house for 3 weeks. Well, if you do something like that, the 3 weeks that they stayed in your beach house is going to count as personal use for you when you're trying to make this determination. And then the last one is anyone who uses your home at less than fair rental price. So, for example, you may have gone to one of these charity auctions at a school or a church or something like that, and someone who owns a rental house will donate that to the charity so that they can offer that as an auction item. So, hey, stay 2 weeks in this rental house on the beach. And then people can bid on that. And then let's say they agree to pay $2,000 to stay at this beach house for 2 weeks. They give the $2,000 to the charity. Then the person who owns the house, they're not actually receiving any money at all. They just did it as a charitable contribution. Those days that the family, whoever won the auction, those days that they stay there are going to count as personal days for the owner of that house. Similarly, if you were just to say you had some friends and you said, hey, we've got this rental house at the beach, but you're friends of ours. So if you want to go down there, you can stay for free. Or we'll just let you stay for the cost of cleaning the house. We pay somebody to go in and clean the house. And so just reimburse us for the cost of cleaning the house and you can stay there. So they're paying much less than the fair rental price. Those would count as personal days for the owner of the home. You can, though, see there is this exception down here. If you take your family to your rental house, but you spend your time working substantially full time repairing or maintaining the home, then you do not have to count those as personal days, even if your family is staying there. So you take your family down to the beach home, they go out during the day and enjoy the beach. You spend your days doing repairs and maintenance. Those do not count as personal days. However, if instead of just doing repairs and maintenance, you are making additions or improvements, so you're adding on a new room to the house, then those would still count as personal days. So once again, we have to distinguish between repairs and maintenance and making capital improvements. So how do you separate out the personal expenses from the rental expenses if you are renting out a home? And the way you do it is you take the total rental expenses multiplied by the total number of days that it was rented out at a fair rental price divided by the total combined number of rental and personal use days. So we will do an example of this here coming up. Just note that any day the unit is available for rent but is not actually rented is not a day of rental use. So if you rent it out for 100 days a year and you use it personally for 20 days a year, then in order to figure out your deductible rental expenses, you would take your total rental expenses by 100, which is the number of days you rented it out, divided by 120, which is the total number of rental and personal use days. And you would use that fraction to determine how much you could deduct. You don't get to say, well, it was available for rent the rest of the year. So it was available for rent for the other 245 days. So therefore, I'm going to count that as rental days. That does not work. It's only the actual number of days that it was rented out that will count. So let's look at an example. Loretta lives in New Jersey and owns a vacation home in Florida. She stays in the home for 30 days in 2023 and rents it to others at a fair rental price for 90 days, earning $27,000 in gross rental income. The house sits vacant the rest of the year. Loretta has $16,000 of total expenses for the home for the year. She can deduct 75% of those. So 90, which is the number of days she rented it out, divided by 120, which is the number of days she rented it out, plus the number of days she used it personally. So 90 divided by 120 is 75%. So she can deduct 12,000 of those $16,000 of expenses and deduct those on her Schedule E. So she then will report net income from rental properties of $15,000. So it's the $27,000 of rent she received minus the $12,000 of deductible expenses. Renting out your home as opposed to a different type of property is not considered a passive activity. However, if rental expenses exceed rental income, you still cannot deduct the loss against other income. However, you can carry that loss forward to future years as a rental expense for that year. So if you have a loss this year, you don't get to take that loss this year, that $25,000 passive activity loss exception we talked about does not apply because this is not considered a passive activity. So you can only deduct your expenses up to the amount of your income when you are renting out your home, whether it's your main home or a vacation home. But the additional losses can be an expense next year. So it's not a passive activity loss carry forward. It is actually a rental expense carry forward. So next year you get to count it as an expense. And if you still can't deduct it, then you can carry it to the next year as a rental expense and so on. And then for any real estate, but this is really especially going to apply to homes, but for any real estate, if you are not renting out that real estate with the intention of making a profit, then you can only deduct your losses up to the amount of your income and you cannot carry any losses forward. So if you have a vacation home that you really don't intend to rent out, but once in a while, maybe some friends or friends of friends say, hey, look, we'd like to stay down there and we'll pay you for it. And you say, okay, that's fine. And you let them do and you accept whatever they pay you. You're not really trying to earn a profit on it. You're just happening to rent it out every once in a while. So you're not really trying to make a profit on the house. Then you can still deduct your expenses to reduce your income, but you cannot take a loss on the property. Now, if you do have a gain on the property, you have to report the gain. But if you have a loss, you are not allowed to deduct the loss nor to carry the losses forward. Then we get to the somewhat famous Augusta rule, or the 14-day rule. If you rent out your main home or vacation home for 14 days or fewer, you do not have to recognize the income and you cannot deduct any expenses. But this is actually an opportunity to have completely tax-free income. If you rent out a home for 14 days or fewer during the year, you don't have to recognize any of the income. You don't have to pay any tax on that income. This is called the Augusta rule because the people in Augusta, Georgia, where the big famous golf tournament is played every year, for that week or whatever it is of the golf tournament, all these people pour in to that town, Augusta, Georgia. There's not enough hotel rooms to accommodate everybody, so people rent out their houses to these people coming in for the tournament. And they could sometimes rent those houses out at a very nice rental amount and make a very nice profit on that. And so somehow these residents of Augusta, Georgia were able to go to their congressmen and senators and say, hey, look, we don't want to have to pay tax on this. It's a pain to try to keep track of everything. We're only renting it out for a week or 10 days. why should we have to deal with taxes when that's all we're doing? And so they were able to go to Congress and get this rule put in that says, yeah, you're right. If it's 14 days or less, and that's all you're renting it out, then we're not going to worry about it. You don't have to pay taxes on it. So that is the Augusta rule, but it applies to any home, whether it's your main home or a rental home. If you rent it out for 14 days or less during the year, then you don't have to worry about it. You can't deduct a loss, of course, but you don't have to worry about reporting any of the income. You just ignore it. You don't put it on Schedule E. You don't put it anywhere. You just take the money and you don't have to pay tax on it. That is a rarity in the tax law. So, kind of something interesting to know. And you could get a question about it on the exam as well. So now let's move on to farming and farmers. What we will look at specifically is we'll do an overview of farming. We'll talk about accounting methods, recognizing income, and then some special things with the tax computation. So, what is a farming business exactly? How do you know whether or not you qualify as a farm? You are in the business of farming if you cultivate, operate, or manage a farm for profit, either as an owner or a tenant. So you'll want to remember all of those things: cultivate, operate, or manage, and it has to be for profit. So it's not just kind of a sideline thing you're doing. You've got your little vegetable garden out back that you do as a hobby. That is not a farm, right? So you're cultivating, operating, or managing a farm for profit. And you can either own it or you can be a tenant. So you're renting it, but you are working that farm. Then you are in the business of farming. A farm includes livestock, dairy, poultry, fish, fruit, truck farms. It also includes plantations, ranches, ranges, and orchards and groves. And a farming business is a business. And so most of the tax rules that we've already talked about are going to apply to farms as well. However, there are some differences, which is why it is separated out, and we are talking about it specifically because there are some things that are different with a farm than with other businesses. But remember, in general, a business is a business, and so most of the same rules are going to apply to farms as well. A farm can be operated as a sole proprietorship, a partnership, a C Corp, or an S Corp, just like any other business can. It's the nature of the activity that makes it a farming business, not the type of entity that is running the farm. Sole proprietors, they report their farming income and expenses on Schedule F of Form 1040 instead of Schedule C. Other entities report their farming businesses just on their regular forms. So a partnership reports it on a 1065, an S Corp on an 1120S, and a C Corp on an 1120. So there's no difference there. As we are talking about farming in this video, we are, for the most part, going to assume it's a sole proprietorship or a qualified joint venture, because it's just easier to talk about Schedule F and individual farmers than it is to talk about a corporate type of farmer. So we're going to talk that way about it just to make it easier and more straightforward, but the same concepts are going to apply no matter what type of entity is actually running the farm. So this is Schedule F. So let's just take a closer look at it. And you start at the top. So it looks a lot like Schedule C, except for Part 1 and Part 3. Part 1 is farm income computed if you use the cash method of accounting. Part 3, as we'll see, is farm income if you use the accrual method of accounting. So you're going to use one or the other. So you're either going to fill out Part 1 or Part 3, but not both. So you can see here in Part 1, you are just going to show your income using the cash method. sales of purchased livestock and other resale items, in cost or basis of purchased livestock, etc. So you're going to go down through all the lines and figure out your income. Part two, you're going to use, no matter what your method of accounting is, that's where you're going to show your expenses. So they look a lot like Schedule C, except you've got some special categories like chemicals and conservation expense and feed and fertilizer and veterinary expenses, etc. But the same idea as Schedule C, you are showing your expenses, and then you're going to come down to the bottom and you're either going to have a profit or a loss. So then over here on the next page, this is where we show that part three that we talked about. So this is, if you use the accrual method, this is where you're going to show your computation of your income. Then you're going to use those same expenses from part two to figure out your profit or loss. So that is Schedule F. So now let's talk about those accounting methods. We can see right there on the Schedule F, there's a big distinction between cash and accrual. So like any other business, farmers can use the standard accounting methods. So they are going to choose either cash or accrual as their primary method of accounting. Then they can also use for certain items other methods. So they could use a hybrid type of method like other businesses can. And then there are also special methods that apply just to farmers that they can use for certain items. So we are going to talk about a few of those. So one of those special methods that they can use with IRS approval is called the crop method. So this is for farmers who do not harvest and dispose of their crop in the same year they plant it. So maybe they plant it in the fall and they harvest in the spring, this particular type of crop. So it spans two different tax years. So they might want to use this special method. Or maybe they have a crop that takes more than a season to grow. So maybe it's in the ground for a year or two or longer before they harvest it. So they might want to use this crop method, and they can request from the IRS for approval to use it. So what it does is it allows you to deduct the entire cost of producing the crop in the year you realize income from the crop. So maybe you plant it in the fall and you've got all of your expenses for planting it. But instead of recognizing those expenses in that year, you wait, and when you harvest in the spring and then you sell the crop that spring and summer, you wait and you recognize those expenses in the same year that you recognize the income. That's what the crop method does. So it matches the year that you recognize the income with the expenses, even though those expenses were actually incurred in a prior tax year. So that is the crop method. Next is farm inventory. So when we are talking about inventory on a farm, we are talking about all products held for sale, purchased for resale, and supplies, such as for a hatchery, it includes eggs in the process of incubation, all harvested and purchased farm products held for sale or for feed or seed, such as grain, hay, silage, concentrates, cotton, tobacco, etc. Supplies held for sale or that become part of items that are held for sale. So that's similar to other types of businesses. And livestock held primarily for sale. Livestock that's held for other purposes, such as draft, breeding, or dairy, can be included in inventory if you want to, or it can be depreciated. So that is up to the farmer of how they want to treat that. Crops that are growing, so they're still in the ground, are usually not held in inventory. Although if they have a reproductive period of more than 2 years, you may include those in inventories. So if it's a type of crop that you plant in the fall and harvest in the spring, well, obviously then at the end of the year, those crops are in the ground, but you do not include those in inventory. But if it's something that's going to be in the ground for 2 years or more, then you may include that in inventory. So that's how that works for farm inventory. Farmers that meet the gross receipts test, remember that $29 million average gross receipts over 3 years. So if they've got less than that, then like other businesses, they are not required to account for inventories. Instead, they can treat inventories as non-incidental supplies or use any other method that conforms to their book accounting. So they can just use whatever method they normally use for keeping their books, or they can treat those inventory items as non-incidental supplies. Farmers who do account for inventory can use the same inventory methods as other businesses. So FIFO, LIFO, average cost, just like we talked about before. In addition, there are two special methods that farmers can use. They can use something called the farm price method and something called the unit livestock price method. So let's talk about each of those. The farm price method. Under this method, each item, whether it's raised or purchased, is valued at its market price less the direct costs of dispositions. And the cost of disposition includes commissions, freight, hauling fees, marketing costs. So with the farm price method, you're not using the cost, you're actually using the value, the market price. The market value is what you are using, and then you subtract these costs of disposition. So that's what you use to compute the value of your inventory. If you use this method, you have to use it for all of your inventory, except for livestock. Livestock, you're allowed to use instead the unit livestock price method that we will talk about next. The unit livestock price method, this method is here because it recognizes the difficulty of establishing the exact cost of producing and raising each animal. So you've got all these different animals. Some of them you're going to spend more money on, and some you're going to spend less money on. Some types of animals you're going to spend more or less money on. And so, since that can sometimes get difficult to figure out, you might choose to use this unit livestock price method. So what you do with this method is you group your livestock according to type and age and use a standard unit price for each animal within the group. The unit price has to reasonably estimate the normal costs incurred in producing the animals in that class of animal. So you would maybe separate out your cattle from your horses, from your goats, from your chickens, and you would figure out for each type of animal what is the standard cost of raising this type of animal. So if you look at all the feed and all the veterinary fees, etc., how much would it cost on average to raise each type of animal? And then you would assign that cost, that price, to each animal in that class, and then that is what you would use to value your inventory. If you do choose to use this method, then you must use it for all your raised livestock that is kept in inventory, regardless of whether they are held for sale or for draft breeding, sport, or dairy purposes. So remember, you don't necessarily have to keep those animals that are used for draft breeding, sport, or dairy purposes in inventory. But if you do keep them in inventory and you use the unit livestock price method, then you have to use it for all of those animals. Depreciation of farm property. New machinery and equipment used in farming has a 5-year recovery period. Used machinery and equipment has a 7-year recovery period. So you will want to remember those for the exam. This actually seems a little counterintuitive. If you think of standard depreciation methods that use a useful life, it wouldn't make sense that a new machine has a useful life of 5 years and a used machine has a useful life of 7 years. You'd think it'd be the other way around. A new machine should last longer and have a longer useful life than a used machine. But remember, when we're talking about tax depreciation, they don't call it useful life, they call it recovery period. So they're not necessarily looking at this as which one is going to last longer. They're just saying for new machinery, you get to depreciate that over a shorter period of time than you do for used machinery. Why would they do that? Well, likely it's because they're trying to encourage farmers to buy new machinery because that helps to spur the economy. So they're saying if you buy a new piece of equipment, we'll let you depreciate it faster, get those deductions sooner than if you buy used machinery. But the important thing for the exam is just remember new machinery, 5 years, used machinery, 7 years. Here is a chart that comes out of that farming publication that is mentioned at the beginning of the video that shows for the various types of farming assets what the recovery periods are. And we have here the general depreciation system, which that's what we use for acres, as opposed to that alternative depreciation system that we did talk about briefly as well. But we're going to focus on the general depreciation system. So these are the various assets. I already said here we've got new farm machinery equipment is 5 years, used is 7 years. So I highlighted those because you'll definitely want to know those for the exam, but they are on here as well. The other one that you might keep in mind is these single purpose agricultural structures are 10 years. And then similarly down here, you've got the single purpose horticultural structures are 10 years. Those are a little unusual because they are structures like real property, but they've got only a 10-year recovery period. So that is a little bit different with farming. Most of the time, remember we just talked about rental properties, a commercial building has a 39-year recovery period. Well, here you've got agricultural structures that only have a 10-year recovery period. So that is one that you might want to remember as well. Then the rest of these, you don't have to memorize these or anything like that, but you can just look down. So you can see other farm buildings have got 20 years. So even those, that's about half of what a typical commercial structure would be. So it's only 20 years instead of 39 years. And then you can see we've got various animals, goats and sheep, 5 years, hogs are 3 years, horses can be different years depending on what they are used for, and so on and so forth. So it's kind of interesting to read down and this and see what some of these lives are. But again, you don't have to memorize them, just focus on those few that we talked about. Farming income. How do we recognize income from a farming business? So for the sale of farm products and assets, sales of products of a self-employed farmer are reported on Schedule F, just like other businesses report their sales on Schedule C. Now, you do remember, of course, that if you're on the cash method, you're going to report your income a little bit differently and in a different place than if you are on the accrual method, but still, you're reporting it just like you would on Schedule C. Gain on the sale of livestock that's born on the farm is generally the gross sales price less any expenses of the sale, such as commissions and freight. So the basis of the animal will be considered to be zero, assuming that the expenses of raising it were deducted when incurred, which is what you would normally do. So that animal is born on the farm. You're probably going to have the vet come out and check the animal out. So you're going to have expenses, veterinary expenses, and you're going to go ahead and deduct those. You're obviously going to feed the animal. That's going to cost money. You're going to deduct the cost of your feed. So since you're deducting all of these expenses as you go along, your basis in that animal is zero. So when you sell the animal, it's just going to be the sales price minus whatever the costs of the sale were, and that is going to be your gain on the sale of that animal. If you purchase an animal and then later sell it, then it's going to be like other assets. You're going to have a basis in that animal. You're going to subtract the basis from the sales price, and the result is the gain. Sales of non-inventory assets, such as land, tractors, livestock, that are not kept in inventory, those are going to be reported on Form 4797, just like with other businesses. If you sell non-inventory trade or business assets, you're going to report the gain or loss on Form 4797. Section 1245 property. So remember, we talked about 1245 is generally personal property, 1250 is real property. So buildings are not usually considered 1245 property, but those single purpose agricultural and horticultural structures that we talked about that have a 10-year life, those do count as 1245 property. So that means they are subject to depreciation recapture when they are sold. Section 1231 property, you'll remember this is that special property that gets favorable tax treatment. If you've got 1231 property and you sell it as a gain, you count it as capital gain. And if you sell it as a loss, you count it as an ordinary loss. So that's going to apply to farmers as well, but there are a few special rules. Remember, Section 1231 property for other businesses, it's going to be property used in a trade or business that was held for more than 1 year. But for farming, there's a couple of little differences. For horses or cattle that are held for draft, breeding, dairy, or sporting purposes, so they're not in inventory. Obviously, if they're in inventory, then they're not Section 1231 property. But horses or cattle that are not held in inventory, instead of owning them for more than a year, you have to have owned them for 24 months or longer, so for 2 years or longer. Other livestock other than horses or cattle, then it is for 12 months or longer. Depreciable property used in farming that's held for longer than a year, so that's just like with any other business. Real estate held for longer than a year. Unharvested crops. So if you've got crops that are still in the ground and you sell those, then it doesn't matter how long they've been in the ground. Those will be considered a Section 1231 asset, so you can get a capital gain or an ordinary loss on the sale of those. And then cut timber. So trees that have already been harvested and they're cut, those are again going to count as Section 1231 property. Weather-related gains. Sometimes the farmer will sell livestock that they normally would have held on to for a little longer before selling, but because of the weather, they're afraid that they're not going to be able to make it, that those livestock aren't going to live long enough to make it to market. So they sell it prematurely. They sell it sooner than they would so that they can at least get something out of that sale rather than having the livestock die due to the weather problems, and then they wouldn't get anything for them. So if they have that situation where they sell it earlier than they normally would have, then they may be able to postpone the gain from those additional animals until the following year. But in order to do so, they have to meet all of these criteria. They have to be in the business of farming, so that shouldn't be a problem. They have to use the cash method of accounting. So if they use accrual, they can't do this. They have to be able to show that they would not have normally sold those additional animals if it were not for the weather-related conditions. So maybe they can show historically, this is what we've done. We hold these animals until their certain age or until a certain time of year before selling them. But this year, we didn't do that. We sold them early. So they have to be able to prove that. And then also the area does have to be designated as a federal disaster area. So it has to have been designated for federal disaster assistance. So if you meet all of those criteria, then you can wait and recognize the income from selling those additional animals until the following year. Crop insurance and disaster proceeds. So crop insurance and government disaster proceeds that are received as a result of destruction or damage to crops, or for the inability to plant crops due to drought, flood, or other natural disaster, those payments are generally taxable in the year that they are received. However, they can also be postponed until the following year if you meet certain conditions. So you have to meet all of these conditions. First of all, the farmer has to use the cash method of accounting. Secondly, the proceeds are received the same year that the crops were destroyed or damaged. So if you're getting a payment now for crops that were destroyed last year, then you cannot delay anymore. You have to report those in the year that they were received. But if you're getting those proceeds in the same year that the crops were destroyed, then they can still be eligible for being postponed. So then the third criteria you have to have is that under normal conditions, the farmer would have included more than 50% of the income from the crops in the year following the year of damage. So if these crops that were destroyed, if you would have gone ahead and sold those this year anyway, then you are not eligible to postpone including the income from the insurance or the disaster proceeds to next year. If you would have gotten the income this year anyway, then you include those proceeds and income this year. But if you can show that normally you would not have included those crops or more than 50% of the income from those crops until next year, then you are eligible to postpone including the proceeds from the insurance until next year. And when you do this, a statement must be attached to the tax return naming the specific crops that were damaged and the amount of the insurance or disaster proceeds that were received. Subsidies. Agricultural program payments or subsidies and similar government payments are included in income in the year they are received. They are reported in Part 1 of Schedule F. Even if the payments are later repaid, you still report the full amount as income, but an offsetting deduction is allowed. So let's say you get a subsidy from the government, and then it turns out you don't qualify for part or all of that subsidy, and so you have to pay all or some of that money back. You still report it as income because you did receive it, but then you can take a deduction for the amount that you paid back. Patronage dividends. When a farmer belongs to a co-op, a cooperative, they share in its profits. And those profit distributions are called patronage dividends, and they are taxable. So it's like a dividend. So they will be reported on a 1099 PATR. So it's a special kind of 1099. Rather than using a 1099 DIV, they use this 1099 PATR. But any dividends that are related to personal purchases are not taxable, but reduce the basis of the item purchased. So it's a co-op, so the farmer themselves are probably also buying things from the co-op. And so any of the dividends that they receive that are related to their own purchases are not going to be taxable, but they do have to reduce the basis in those items. So if they are going to resell some of those items, for example, then their gain on the sale is going to be greater than it would have been. So that is how we handle patronage dividends. Conservation payments. Payments under the Conservation Reserve Program are taxable. There are some other types of what are called cost-sharing conservation payments that may be fully or partially excluded from income. You don't need to know the details of that, just know that they do exist. Rent income from a farm. Cash rents received for the use of farmland are generally rental income rather than farm income, so they are going to be reported on Schedule E, just like we just talked about previously in this video. If, though, those rents are received as crop shares, they are reported on Form 4835. So if instead of receiving cash for the rent, they're going to give you a share of the crops, then you don't report it on Schedule E, you use this Form 4835. If the farmer materially participates in operating the farm from which the rent or crop shares are received, then it is self-employment income and reported on Schedule F. So if you're actively working this farm and you happen to be receiving rent as well, then that is just part of your normal farm income, you put it on Schedule F. The tax computation. So for farmers, there are some special provisions. We've got income averaging that can be done, the self-employment tax optional method. Estimated tax payments are a little different for farmers. The payroll reporting forms are different, use a 943 instead of a 941, and NOL carrybacks are handled differently, so we will talk about each of these. Income averaging. So farmers may be eligible for this special 3-year income averaging. So this is when the current year income is high and it was low in any of the 3 previous years. Those are called your base years. So this helps to smooth out the ups and downs that can come with farmers. So farmers can have really good years and then they can have really bad years. So rather than kind of punishing them by making them pay a lot more tax in the really good years, this allows them to use income averaging to kind of smooth that out. But you don't change anything in the previous years. So you're not going backwards and amending any returns or anything like that. But what it does is it allows the farmer to take advantage of the lower tax brackets from those previous years in this current year, thereby lowering the current year taxes. So they do this by reporting it on Schedule J, which is an income averaging for farmers form. And they did not have to be in a farming business in those previous years. So if their income was lower in the previous years, even if they weren't in the farming business, they can still use those previous years for purposes of income averaging this year. And they don't have to use the same filing status. So maybe they were single before and they're married now, or vice versa. They don't have to use the same filing status. However, they cannot use this for purposes of the alternative minimum tax. Self-employment taxes. Self-employed farmers, they are subject to self-employment tax, just like any other business owner is. And they compute their self-employment tax just like every other business owner does. Certain farmers, though, can use an optional method if either gross farm income is not more than $9,840 or net farm profits are less than $7,103. So we're talking about farmers who have little or no income and may even be operating at a loss. So if you're doing self-employment tax and you have a loss from your business, then you don't owe any self-employment tax. So what this is doing is allowing the farmers to go ahead and report some self-employment income, even though technically they don't have any. So what it does is it allows the farmer to use 2/3 of their gross income, up to $6,560, as net earnings from self-employment, even if the farm operated at a loss or a very small gain. So you might be asking, why would they want to pay self-employment tax if they don't have to? Because the alternative here would be to say, well, I had a loss, I owe zero self-employment tax, and you just move on and you don't owe it. Well, there are some instances where you might actually want to report income, where you can be better off reporting the income than not reporting the income. And this gives the farmer the opportunity to do that. So first of all, they might want to get credit towards Social Security. So self-employment tax is for Social Security and Medicare. And if they want to get credit towards Social Security for their retirement, they might want to show some self-employment income. So that's one reason they might do it. Then the other reason they might do it is in order to be able to utilize certain credits. So as you might remember from part 1, when we talked about individual taxation, there are certain credits that refer to your earned income. You can only get the credit to the extent you have earned income. So this allows the farmer to report some earned income even though they actually had a loss. So the credits that are affected are the child and dependent care credit, the earned income credit, and the additional child tax credit. Estimated payments for farmers. Qualified farmers do not have to pay estimated tax if their return is filed by March 1st and all tax due is paid with the return, or they have paid through withholding or applied from the prior year's tax return an amount equal to either 100% of the prior year's tax or 2/3 of the current year tax. If neither of those apply and the farmer expects to owe $1,000 or more, they must make just one estimated tax payment of 100% of the prior year's tax or 2/3 of the current year's tax by January 15th. So if we're talking about the 2023 tax year, they would have to make that payment by January 15th of 2024. And a qualified farmer for this purpose is one for whom farming represented at least 2/3 of their gross income for either of the prior 2 years. So, in other words, you're not just a new farmer this year, but you were a farmer for either one of the prior 2 years as well. So, this is very different from other individual taxpayers. So, let's think about a sole proprietor farmer here. Most of the time, if you own a business that's not a farm business, then remember you have to make estimated tax payments. Remember April, June, September, and then again in January. But the government here is recognizing that farming is much more difficult to predict because of things like the weather and disease and these things that can affect farmers. It's hard for them to know early in the year how their year is going to turn out. Is it going to be a bumper crop and they're going to make a killing? Or are the crops all going to die and they're going to hardly make anything? So it's very hard to estimate their income. So therefore, it's very hard to estimate the amount of tax that they are going to owe. So therefore, they have these special rules in place. So for most farmers, if you file your return by March 1st, so your return obviously is still due April 15th, like everybody else's. But if you can get it done early and file by March 1st, then you can just wait and pay whatever tax you owe with your tax return. You're not going to owe any penalties or interest for underpayments throughout the year. Even if you don't file by March 1st, if you've already paid in either through withholding from a job or from applying a prior year's refund to this year's return, if you've already paid in an amount equal to either 100% of last year's tax or 2/3 of your current year tax, then you also don't have to make any estimated payments. If those don't apply, so you're not going to file your return by March 1st and you haven't had any withholding or anything that pays that tax, and you expect to owe $1,000 or more, then you just have to make one estimated payment and you make it by January 15th of that year. So if it's 2023, you make it by January 15th of 2024. And the amount of that tax has to be either 100% of your prior year's tax or 2/3 of your current year tax. So if you do those things, you don't have to worry about underpayment penalties or interest. So it's kind of a nice deal for the farmers. And again, it's just recognizing the difficulties of estimating income when you are a farmer. Form 943. Wages paid for agricultural employees are reported annually on a Form 943 rather than quarterly on a 941. So remember when we talked about back in video 1, the different reporting requirements, you have to, for a regular business, you have to report quarterly your wages and payroll taxes on this 941. Well, a farmer doesn't have to do that. For their agricultural employees, they can just report annually on the 943. However, they still have to make their deposits. So just like with the 941, you report quarterly with the 941, but you still have to make your payments either semi-weekly or monthly, depending on the amount due. Same way with the 943. You only have to file the 943 once per year, but you still have to make your payments as you go along. And any wages that are paid to non-agricultural employees will still be reported quarterly on the 941 rather than on the 943. So if you've got someone, maybe you've got a bookkeeper that is working for you on the farm, they're not an agricultural employee, so their wages would still go on the 941. NOL carrybacks. A net operating loss from farming in 2020 or later can be carried back 2 years. So you'll remember when we talked about NOL carrybacks before, most businesses cannot carry them back. They can only carry them forward. But there were two exceptions, as you'll recall. One of those was for farmers, the other was for insurance companies other than life insurance companies. But farmers are allowed to carry their losses back 2 years. So they can go back and amend their last year's tax return or their 2 years ago tax return if they want to carry those losses back. And like any other business, they can carry them forward indefinitely, and they don't have to carry it back if they don't want to. They can just carry them forward if they would rather. And then the normal NOL rules apply to farmers just like they do to everybody else. So, for example, you can only offset 80% of your taxable income with the NOL. Moving on now to tax-exempt organizations. In order to be a 501c3 tax-exempt or not-for-profit organization, it has to meet specific requirements. It may be a corporation, a trust, or an unincorporated association. It may not be a sole proprietorship or a partnership. It must be established for a charitable, educational, or religious purpose. You will want to remember that. Charitable, educational, or religious purpose. Cannot have earnings which benefit the member of the organization or any insiders of the organization. Cannot directly or indirectly participate in a political campaign for or against a candidate for political office, and cannot lobby for or against legislation in any significant way. So you have to meet all of those in order to be a 501c3 organization. And you have to apply to the IRS for tax exempt status, and you do that on this Form 1023. However, churches, synagogues, mosques, and temples do not have to apply, though they are allowed to. So a church or synagogue, etc., they are exempt from needing to apply. They are automatically going to qualify as a 501c3 organization, even if they do not apply. And the reason is because of the constitutional guarantee of separation of church and state. That's why they do not have to apply. An organization that does apply will get a letter from the IRS, a determination letter that will either approve or deny their application. Once they are approved, then they are tax exempt, and donations to the organization are eligible for tax deductions. There are other types of tax exempt organizations. They are going to be considered tax exempt. However, donations to them are usually not going to qualify for tax deductions. And in order to apply for that other type of tax exempt organization, they have to file this Form 1024 instead of the 1023. Tax-exempt organizations other than churches, synagogues, mosques, and temples must file an annual tax form. It's called a Form 990, or they have to file one of them in the 990 series. So the main form is called the 990, and every tax-exempt organization that is not a church, synagogue, etc., has to file one of these every year. They can file this 990 Easy instead, it's the short form, if their gross receipts are $200,000 or less and their total assets are less than $500,000. There's also a 990N for even smaller organizations. That's called the e-postcard, and that's for organizations that are not required to file the 990 or the 990 EZ, because they have gross receipts of $50,000 or less. And then there is this 990 PF, and that is for either tax exempt or taxable private foundations. The 990 reports the organization's receipts and expenses along with other information. It is due on the 15th day of the 5th month after the tax year ends. So that is May 15th for a calendar year organization. The 990s are available to the public. So this is much different than an income tax return for other organizations. If you've got a personal tax return or a corporate or partnership tax return, those are confidential. And the IRS is not allowed to disclose those to anyone. There are IRS employees who have gone to prison for disclosing tax returns of individuals and companies. It is not allowed to happen. 990s are different, though. The IRS is required to make them public. So you will sometimes see there are these watchdog groups who are watching these not-for-profit organizations, and they will go out and they will get these 990s and they will comb through them looking for anything that looks suspicious. And then they will call those organizations out for anything that they see as not being appropriate for that organization. Then the last point you'll see there, if the 990 is not filed for 3 consecutive years, then that organization will automatically lose its tax exempt status. So if you want your organization to keep their tax exempt status, you need to file these 990s. Let's have a look at page 1 of the 990. The regular 990, I think, is around 12 pages long. It's quite detailed. You'll see here, this is the 2024 one. The 2023 one is substantially the same. And it does say right here, open to public inspection. So it's letting you know, in case you didn't know, that what you're putting on this form is available to the public. They're telling you right there that it is in fact open to public inspection. So then you're going to put in all of the information about the organization, what their tax exempt status is, etc., a brief description of what the organization does. And then you're going to get into all of the revenues, all of the expenses. You have to put your assets and your liabilities. And the reason this form is so long is because all of these things, they're all totaled here on the front page, but the detail for all of these things is shown on the later pages. So when you have a 990, and again, I encourage you to get the 990 and look through it, and you're going to see the great amount of detail that these organizations have to go through and report. And again, it's reported out to not just the IRS, but to the public. And so it goes through all of that revenue, expenses, assets, and liabilities, and of course has to be signed. So that is the first page of the 990. Now let's talk about unrelated business income. These organizations, of course, as we said, are exempt from tax. However, if they have a substantial amount of unrelated business income, they will have to pay tax on that income. So UBI is the income from a trade or business regularly conducted by an exempt organization and not substantially related to the performance by the organization of its exempt purpose or function. And the use of the profits from the activity for the exempt purpose do not alone make it substantially related. So if you've got an organization that's just trying to raise money by running a business, they're going to have to pay tax on the amount of money that they get from that business. You can't just say, well, we're running this business in order to fund this charitable purpose, therefore that is tax exempt. That is not enough. Now, if you are running a business that is substantially related to your exempt purpose, to why your organization exists, then you do not have to pay tax on that income. So let's look at a couple of examples to understand what we're talking about here. Example 1. An exempt organization organized and operated for the prevention of cruelty to animals receives unrelated business income from providing pet boarding and grooming services for the general public. These activities don't contribute, importantly, to its purpose of preventing cruelty to animals, and the income is therefore taxable. So, yes, it has to do with animals. It's a pet grooming and boarding service, but that's not anything that's actually helping to prevent cruelty to animals. The money might be going to helping cruelty to animals, but the boarding and grooming itself is not helping to prevent cruelty to animals. Therefore, the income that organization earns from running that business is going to be taxable. Example 2, a halfway house organized to provide room, board, therapy, and counseling for persons discharged from alcoholic treatment centers also operates a furniture shop to provide full-time employment for its residents. The profits are applied to operating the costs of the halfway house. The income from this venture is not unrelated trade or business income because the furniture shop contributes importantly to the organization's purpose of aiding its residents' transition from treatment to a normal and productive life. So in this case, the people that are working in the furniture shop are the people that are being helped. So it is helping them. They are learning how to come to work every day. They are learning how to work at a job all day and how to support themselves. And they're learning a trade or business skill that they can use to get a job when they are released from treatment. So in this case, not taxable income. So you are running that business as part of your charitable purpose. Therefore, the income is not taxable. If an exempt organization has $1,000 or more of unrelated business gross income before expenses, then they must file this Form 990T, which is where they report this business income, and they have to pay tax on that income. Now, the income is going to be taxed on the net profits. So it's the gross receipts minus the expenses. You have to file the 990T if you have $1,000 or more of gross income, but you pay tax on the gross income minus the expenses related to creating that gross income, just like any other business would. And the tax rate is the corporate tax rate of 21%. So now you are up to date on what you need to know for the enrolled agent exam with regards to rental real estate, farming, and tax-exempt organizations. That will do it for video 8. I will see you on video 9.